Yeah, all good.
We've started. Okay. Good morning, everyone, and good evening to those joining us from the US. Welcome to the QuickFee Q2 FY24 Business Update webinar. On our call today, we have Simon Yandel, CFO, and Jennifer Warrower, President North America, to run through the presentation. And my name is Katie McKenzie, Investor Relations for QuickFee. The presentation will run for about 30 minutes and then we'll open up for Q&A. We won't be using the hand raising function, so if you have any questions, please type them into the Q&A tab at the top of the screen. If we don't have time to get through all the questions today, we'll reach out to you directly following the webinar. And now I'd like to hand over to Simon Yandel.
Thank you, Katie. Good morning, everyone. We're pleased to announce a record quarter of revenue up 38% on PCP to $5.1 million. Performance of our finance product was the standout. We can move to the next slide. Yes. In the US, total transaction values, or TTV, were up 45% versus Q2 FY23. Revenue was up 58% and revenue yield was up 70 basis points. In Australia, finance TTV was up 23% and revenue was up 55% on PCP. Revenue yield was up 280 basis points, and our Pay Now product in the US grew volume 17% and revenue 20%. Our strategies around US sales and marketing are delivering results, with finance TTV in the month of December reaching a record $3.3 million. Strategic partnerships with the Lineal Global and Iris Software Group are progressing well, and the Australian business is continuing to grow with increasing demand for our finance product in the higher interest rate environment we currently see. In Q4, we finalised a $10 million facility to support growth in our Australian legal disbursement funding product. This facility provided over $4 million of additional liquidity on close. We continue to approach operating profitability. Revenue growth for the first half of this financial year of 35% is expected to deliver improved H1 EBITDA versus the prior period last year when we release our half-year results. And H2 FY24 is expected to deliver improved revenue and EBITDA over H1. Move to the next slide. To provide additional context to how our fiscal year performance is split into two halves, the chart on the left shows quarterly revenue, with Q4 traditionally the stronger quarter. You can see in FY24, revenue grew from Q2 to Q4, in FY22, from $2.5 to $3.5 million. And in FY23, Q2 revenue of $3.7 million grew to $4.3 million in Q4. On the right-hand side, you can see our track revenue of revenue growth by half year. We expect similar trends to continue in the second half of FY24. It's worth recapping on seasonal fluctuations in both markets, as TTV does not always increase every single consecutive quarter. Q2 and Q4 are traditionally the stronger quarters in both markets, but for different reasons, and I'll step through some of these. Q1, which is July to September, is the Northern Hemisphere summer and US vacations impact activity in that market. In Australia, the start of the financial year after 30 June is usually less busy. The December Q2 quarter is the lead up to the start of the US tax season on 1 January, and firms are keen to invoice as much as they can before they get busy with tax season work come January. In Australia, similarly, it's the lead up to the summer break, with firms rushing to complete work and collect as much cash as possible before the holidays. Q3, Jan to March, is the tax season in the US, runs from 1 January to 15 April. Firms are busy with tax work, with seasonally less invoicing. In Australia, January in particular is very quiet with the long school holidays. And in Q4, the US tax season finishes and a backlog of billing is done. In Australia, it's the lead up to the end of financial year and firms want to collect as much cash as possible before 30 June. So the quarterly seasonality shown top left traditionally repeats every year, with Q4 being the strongest and Q2 being the next strongest. On the next slide, we've shown this the last couple of releases, and it shows the split between price and volume growth in our finance product. Finance growth this year, half year, was 60% in the US and 55% in Australia. The chart on the top right of this slide shows Australia lending volume for H1 FY23 and H1 FY24. Then the revenue yield percent we make from that volume, which is simply revenue divided by volume. And on the far right, where the current quarter and half revenue growth over PCP has come from. You'll see that in that last column, $0.5 million of revenue growth is from the higher volume of lending, and another $0.8 million is from the increase in rates we've charged and revenue yield over and above the PCP revenue of $2.3 million. Similarly, in the US chart bottom right, $0.25 million US dollars has come from volume growth and $0.2 million from yield growth. Revenue from lending will naturally increase as we write more loans, just based on higher volume. And the interest revenue is recognized over the life of these loans. And because of that, there's a long tail of revenue to be recognized at those high yields across the rest of FY24 from loans already made. We continue to incur minimal bad debts with our low credit loss business model. And as a reminder, that model is where the firms guarantee the payment plans taken out by their clients. So if the client does default, the firm makes us whole, which is one of the reasons we have such low credit losses. I'll now pass over to Jennifer to talk a little bit more about what we do.
Great, thank you, Simon. So I wanted to take a few moments to recap what the QuickFee platform includes and what our primary product offerings are. Founded in Australia, QuickFee's been in business since 2009, entering the US market in 2016. Since our inception, QuickFee has had one mission: to help professional service firms get paid faster. QuickFee's payment platform allows a firm's clients to pay now through ACH, EFT, or credit or debit card, which we refer to as Pay Now. Think of this as traditional digital payments. Then we also offer a lending option that's proprietary to QuickFee, called QuickFee Finance. This pay over time option gives clients the option to pay over 3, 6, 9, or 12 months, while the firm gets paid in full upfront at absolutely no cost to the firm. Finally, our Connect product is a significant growth enabler in the US market. Our existing customers have a combined annual revenue of around $10 billion. Right now, only $1.2 billion of that annual revenue is processed through QuickFee. The remaining $8.8 billion is primarily being received by the firm in the form of checks. As digital payment adoption in the US accelerates, our total transaction volume organically increases. In other words, as the US market continues to mature in its digital transformation journey, there's over $8 billion in annual transaction volume we could capture from our existing customers alone. Now, this is where Connect comes in. Connect provides integration into leading practice management solutions, helping turn a manual, often paper-based invoicing process into an automated digital process by sending out the invoices generated within the practice management solution via email. Those invoices have a payment link on them, which sends the customers directly to the QuickFee payment page. We currently have 3 integrations: CCH Pro System Effects, CCH Access, and Iris Practice Engine, and a number of others in the queue, which I'm going to speak to in just a few moments. Now, on the next slide, I want to dive into some of the efforts underway that have supported our growth in Q2. Our new sales strategy and operating rhythm, led by Chris Smith, has been a significant driver of our growth in the US market. Chris has led the transformation of the sales and customer success functions, and there are a few highlights that have been instrumental in the results that we're sharing with you today. First, there's been a redesign of the commission structure for both our account executives, who are responsible for acquiring new customers, and our relationship managers, who are responsible for driving transaction volume growth from our existing customers, particularly as it relates to QuickFee Finance and Connect signups. Second, we've taken QuickFee Finance, which was a product line that was underemphasized in our portfolio of solutions, and as a result was underperforming, and have turned it into our fastest growing, most significant opportunity. This effort has included amplifying the value QuickFee Finance brings to both firms and their clients, as well as properly communicating the differentiator it truly represents in the market. Finally, Chris has implemented a new tech stack for our sales and customer success teams, enabling a predictable, repeatable, and highly efficient sales process, which is critical as we continue to accelerate growth and scale the business. In addition to the transformation driven in the sales and customer success functions, we continue to aggressively pursue one-to-many partnership opportunities. Our go-to-market support continues to progress with our recently formed existing partnerships with Lineal Global and Iris Software, And at the same time, we've strengthened our partnership with the likes of other partners that we have, like the BDO Alliance. A great proof point of this is that in 2023, our QuickFee Finance volume by BDO Alliance members was up 47% over 2021, which represents a significant improvement in just 2 years. You can expect to see new partnerships announced in the near future as we finalize conversations with a number of key players in the market. Now, if we flip to the next slide, I did just mention how important QuickFee Finance is to the business as a differentiator, but also as a value driver. In addition to that, QuickFee Finance is our highest margin solution, driving revenue yields that are approximately 25 times that of our Pay Now solutions. Although Simon mentioned it earlier, I think it's worth calling out again that in December, QuickFee Finance volume in the US surpassed the 3 million mark for the first time ever. Next, to dive into our product and development strategy, I'm very pleased with the progress that Dave Moore, our recently appointed CTO, made in the last quarter. He's amplified our focus on quality in our products and is taking an automate everything possible approach, which will increase our efficiency and effectiveness, as well as reduce costs and support our path to profitability. In the coming quarter, we have 2 major integrations we're working on, which we expect to have a significant impact. First, we're working on Thomson Reuters Practice CS integration with Connect. Over 25% of our existing customers use Practice CS as their practice management solution, making it the most used practice management solution by our customer base. By providing this integration, we'll significantly increase our ability to capture more of our customers' payment transaction volume. We're also working on an integration with Nuala. Nuala is widely recognized as the easiest way for large accounting firms to create audit, tax, and advisory engagement letters for all of their clients. Their flexible engagement letter system merges client details into templates and triggers unique customizations that firms can control. This integration will enable further automation of our customers' bill-to-cash workflow and provide access to a best-in-class engagement letter solution. We're very excited about the value this integration and partnership bring to not only our existing customers, but also to the market in general. And as I wrap up this section, I wanted to share with you some of the operational metrics in the US. As you can see on this slide, our US active customers are up 14% to 91,000, and US active firms up 10% to 725. The strategic decision to focus on the core, higher margin finance product in conjunction with a refreshed sales strategy and incentive alignment on commissions has driven stronger finance TTV up 45% on PCP to 7.7 million. And I'll hand it back over to Simon to share some updates on the Australian business.
Thanks, Jennifer. In Australia, our Australian Managing Director, Bruce Coombs, continues to lead the team to sign up new firms and drive organic revenue growth. As you can see on the right-hand side, both volume and revenue have seen consistent growth over recent years, and we expect to continue to post growth as economic conditions work in our favour and we track towards record lending for the full FY24 year in Australia. On the next slide, a few of the operational metrics. Active firm numbers grew 3% in the quarter, up to 423. However, active customers grew 31% to 17,000. So the difference there shows that customers are growing faster than firms, which does show that the market is mature, but also that the recent increase in demand for firms and their clients for QuickFee Finance is being shown in those active customer numbers. The growth has been boosted by growth in our legal disbursements funding, or DF product. And I'll just give a quick recap of what that is. It does provide funding to substantial reputable firms. It provides funding for disbursement costs for large personal injury law firms, which usually costs for medical reports in personal injury lawsuits. One key difference about this product compared to fee funding, accounting and legal fees is the interest compounds and there are no installments repaid during the term of the loan. The loan is normally between 24 to 30 months, excuse me. The interest rates on the DF product are comparable to fee funding. Our funding requirement is higher, of course, because with disbursement funding, because there are no repayments until the end of the loan term. Next slide. In terms of cash and liquidity, the recent facility we finalised with Wingate to fund our DF book has strengthened our balance sheet and will provide up to 10 million Australian dollars to support the growth of the DF business. We have adequate cash and borrowing facilities to become profitable, and we have no plans for equity raisings in order to achieve that profitability. We don't rule out ever issuing capital to take advantage of any opportunities that would bring rapid step change growth, but there are no equity raising plans at present. I'll now pass back to Jennifer.
Thank you, Simon. I want to wrap up today with a summary of our highest level strategic priorities for the business in FY24, as well as our outlook for the year ahead. For those of you who attended our last business update, you will note that these remain unchanged from the previous business update, which is a good thing. We're on the right track and we're getting momentum. Our number one responsibility and assurance to our shareholders is reaching profitability, which is mission critical. We'll continue to manage our cash burn and be exceptionally diligent in managing our expenses. We're confident the opportunity in front of us is tremendous, and we're just really getting started. Leveraging strategic partnerships to drive exponential versus transactional growth remains a key part of our strategy. Finally, I want to assure you that continued enhancement to our systems redundancy and business continuity processes is always high on our list and is one of our new CTO's top priorities. And finally, in summary, we expect growth in both the US and Australia to continue, buoyed by the economic tailwinds and the continued modernization of the US payments landscape. A strong start to FY24 and strengthened management team gives us the confidence that we'll continue building on our existing momentum as we execute on our growth strategy. We'll continue to focus on progressively reducing cash burn in H2 FY24 with a narrower focus on cost-effective product development. And as we track towards operating profitability, these recent results give us confidence we can achieve similar revenue growth in H2 FY24. We've not provided revenue or earnings guidance for FY24. However, as Simon mentioned, 35% revenue growth for the first half is expected to deliver improved H1 EBITDA over PCP when we release our half-year results in February. And H2 FY24 is expected to deliver further improved revenue in EBITDA over H1 FY24. And now I'll hand it back over to Katie to facilitate the Q&A with any questions that came in during the presentation.
Great, thank you very much, Jennifer and Simon, for the comprehensive update. And just a reminder to everybody on the call that if you do have a question, to type it into the Q&A tab at the top of the screen. So we do have a few questions here. Just to start with, so Jennifer, in the presentation, you said that you expected to see new partnerships in the near future as you finalise conversations. Are you able to give any further detail on the types of organisations that you're talking to and the likely timing of new deals?
Yes, that's a great question. When you think about the types of organizations, and we've talked about this a little bit in previous presentations, but the types of partners that we're going after, first, which has been, this one has been ramping, and there's been a lot of conversation going on with different companies that actually offer payment solutions today inside their product, but they don't offer a finance solution. So perhaps they have their own pay now solutions, but they're interested in adding embedded finance to their existing offerings as part of their overall payment suite. We're in conversations with a number of companies in the professional services space that are looking for a solution like that. So that's one type of partnership. Another type of partnership is with companies like, if you think about Iris, and Iris is a multifaceted partnership. Number one, they're a QuickFee Finance customer. So when you think about the fact that they offer finance to their customers that are looking to pay with flexible payment plans, their Iris is a customer of ours. And but they're also a technology partner. So we also offer integrations with their practice management solutions, and we partner on go-to-market. So this is multifaceted partnership, and we'd certainly love to get and are aggressively pursuing more of those Iris-type partnerships. And finally, I'd say that our third type of partnership that we're pursuing, and Nuala is a great example of this, is when we have a technology partner that can help bolster our product offering and help augment the functionality that we have. We want to make sure that we are very deliberate about where we're building versus where we're partnering, and engagement letters is a perfect place for us to partner versus build. And so you can expect to see more technology partnerships to help accelerate our own product roadmap.
Okay, thanks, Jennifer. Sounds great. Simon, we do have a question here on profitability, given that you have had such a strong performance in Q1 and Q2 with the quarterly updates. Obviously, we've got the half year results coming up in February, which is going to talk a little bit more to profitability. But can you sort of talk a little bit to whether or not you think, you know, the first half is going to be profitable, and where that sort of sits as well in terms of the second half, how that would compare?
Yes, thank you, Katie. So first half, even though we're showing strong revenue growth, we expect EBITDA growth over PCP for H1 FY24. We don't expect H1 24 to be profitable at the EBITDA level. H2 is traditionally the stronger of the two halves, and in H2 we do expect to see improved revenue and EBITDA over H1. And H2 will be much closer to profitability than H1, but at this point we're not committing any guidance numbers around hitting profitability in H2.
Okay, thanks, Simon. We've got no further questions there, so I think I'll hand it back over, Simon, for you to wrap it up.
Thanks, Katie. Thank you, Jennifer, and thanks everyone for your support and for joining the call. And we look forward to another strong quarter and half. And once again, thank you for your interest in QuickFee.